We have lots to talk about today. Welcome back to Get Real with Jack and Cindy. I'm Cindy Morrison.
And I'm Jack Wallace. Welcome back. So glad you're here. Yes, we have a lot to discuss. I'm not sure how much detail because it's all just kind of pie in the sky and trying to figure things out. But I will say, I am happy they are trying to figure some things out.
I completely agree because sometimes
Yeah.
I think you have to sort of take a step away from how we've always done it to figure out how we can do it now and in the future.
Yeah, and what we're talking about is the creative financing, changing some of the set standards, the standard 40-year, sorry, the standard 30-year mortgage. Yeah, that was kind of crazy that he thought it was a 40-year mortgage. But yeah, the 30-year mortgage.
And sometimes a 15-year mortgage.
And a 15, but now they're talking about going to a 50. That could be a potential that Secretary Pulte is discussing, which if you don't know who Pulte is, over the housing administration now, but he also is the president and CEO of Pulte Construction or Pulte Houses, which is a big new construction, national, big, huge company.
So he has a vested interest in people buying homes.
Sure, which I'm not opposed to, that
a little
part,
skin in the game is not a bad thing.
And so, that does create a need to get creative instead of just letting the market just kind of toil. But we've tried so many things to get past because, the sugar rush of that low interest rate that we had for so long just got so many people, and more, including myself. And
I refinanced,
Yeah, and so it's like you start doing the math, and it's hard to reconcile moving because they, that golden handcuffs, like we call it.
Right.
And then there are options, but they're not always great options. So one of the things that they've talked about and the president has talked about is a 50-year mortgage. So let me first start by saying that I think it's not good. I don't think it's good. I think maybe it's a good, like, every now and then option for a very specific case, which I will go into.
And there are some specific cases where it could work, but it is not something that the masses should jump in and do.
And honestly,
if it becomes reality.
I think that the way it would work the best is probably not what most people are going to think it would be the best for. But yeah, so the idea is instead of a 30-year or a 15-year, you're amortized over 50. Now, let me also just say, we just mentioned that Pulte is the head of a big construction company, and our president is, a big real estate person. So it makes me a little uncomfortable in the respect that I feel like what they're really saying is the bank can get a 50-year note. So we're talking about a whole lot more interest being paid over that time period.
And let's totally cut you off there. I'm so sorry.
No, you're good.
But let's put this in perspective. The average first-time home buyer right now is in their 30s. So by the time, if they stayed in that same house with the same loan, they would pay it off by the time they're 80.
Which I think is terrible, but I think there's even a worse issue because the normal stay at a house is 7 to 10 years, which is why we compete with the 10-year treasury when we look at mortgage rates. So if you're staying in your house 7 years or 10 years on a 50-year note, your principal is going to be substantially less. You're going to pay substantially less of your principal on a 50-year note than you will on a 30 or a 15. I mean, think about that. If you did a 15, you'd be halfway there to getting that paid off.
Right.
On a 50, you would have barely started scratching the surface of the principal. You would have been paying almost all. So it'd almost be like renting in a way, unless you were going to stay there for the long haul.
Right.
Now, I will say the one way I kind of see where it could be a positive thing for some people is, let's say you really were planning on being there for 2 years and you were going to flip the house but live there to get the tax advantage.
Right.
So your payment would stay low. It would almost be like an interest-only payment for that first 2 years, knowing that you're just using that in order to take your funds and be putting it towards renovating the house, and you're going to do that. So it's basically using it as a vehicle to get into the house, get a low payment, and get you through the 2 years. See what I'm saying? So I think
I get that.
That actually might be something that would be helpful because a lot of builders or real estate investors have the ability to get interest only loans and the public doesn't. So that kind of would be a version of that for some of those situations. But that's a very rare.
I also think, sometimes instead of paying someone else's rent, you're paying your own mortgage, beginning to build your credit. And maybe for somebody who, let's say they're a doctor who just graduated, they've got all these student loans, but they know they're going to be able to make a lot more money. So they could start making 2 payments a month or doubling what they pay and paying it off faster or refinancing.
My hope would be get a smaller house, less money on a 30 or a 15, and eventually move up into that. But I mean, I could see it more with the high earner potential person. The other side of it is if you're talking about it from a rental and building credit, the problem with that is you're still responsible for repairs. So if you're getting in just to get that low payment instead of renting, but you still have to put a roof on, or you have to, do that kind of stuff, you might be better off to rent in that situation because you would have almost no principal or no equity in the house, and you would be maintaining it.
But as it stands right now, you're building your credit on paying your mortgage.
Yes.
They're looking at, my understanding is, also, if you've paid your rent on time,
you now can get that. There's certain ways to do it, like an app where that does help.
So I do see where
that didn't used to happen. You used to didn't get any credit for
exactly. So but if you're only going to look at the mortgage and you're looking at building credit, I get that.
Yeah.
But it kind of offsets that if they are going to look at your rental history and you have a good rental history. But the fact is,
there's ways to build your credit. I mean, there are ways to build your credit without buying a house.
Of course.
So I think I would never say do something that's going to put you in jeopardy just to build your credit in that respect. And I think that for a lot of young people, they would be overreaching to get that lower payment, bigger house. But then a bigger house, lower payment also means more toilets to maintain, more roof to maintain, higher taxes to pay, higher insurance. So you have to think about all that. I mean, I think, and we're both very mom and pop about stuff. So
I would never tell one of my kids, let's do this, guys, because I don't think for either one of them that would be a smart thing. Because yes, that the price of the house is the price of the house.
Yeah.
But depending on whether you do a 15-year note, a 30-year note, a 50-year note, that's all that interest you are paying on top of the price of that house.
And I think what you really have to think about is that the truth is most of us stay 7 to 10 years. And so if you think
except for you and me.
Except for us, yeah. So if you think about it from that standpoint, that 7 or 10 year period, you want to try to pay as much interest as you can to build your equity in that period. And the further you go out in the payoff, in other words, 50 years, it's going to be a whole lot less interest you're going to pay. I mean, principal you're going to pay in the beginning compared to a 15 or a 30. I mean, really, honestly, even a 30, you should be making extra payments.
Right. And you'll pay it off so much faster, pay so much less interest. Well, talking about equity.
So I think it's not really a solution. I think this one is not really a solution, but it's an idea. I think it's a little wonky one. I do think it should be something that's there. I mean, I think it should be there because there are situations where somebody, like you said, might be in a position where right now that could get them in the house and they could refinance to a 30, but that would be very scary to me if they're not in a place to do it right away. But
heaven forbid you lose your job.
But that interest only idea, that could be for like a 2-year flipper. I could see that. I could see that, but that's a very small percentage of people that would be wanting that particular thing.
So let's talk about equity here. So, in
because it is the equity game.
Yes, exactly right. Because people, we're saying, oh, we're going to have a market bubble like we did in, the 80s and how we did in 2008, 2009. Well, in the 80s and 2008, 2009, people didn't have the equity in their homes that they have now.
And they had higher interest payments.
Yes. So how does that affect equity for folks who decide to do this 50-year mortgage?
What do you mean as far as the longevity of it? Oh, well, they're gonna. I mean, it's gonna
I
take
mean,
them forever to get one.
yeah, because they would.
Yeah.
If
I
it's
mean, I
a,
think
if
really they're gonna be. It would honestly be probably for most people. I'm gonna guess it would be worse than renting, because like we talked about, they would have the expense of having to keep the roof up, maintain the property, pay the insurance, the taxes, on top of. So I think you have a set number with their rental.
Mhm.
So that almost is making it like you would be renting, but yet you'd also it'd almost be like if you went to a rental property and they said, here's the monthly rent and you're going to maintain the property.
Right.
Okay, well, that's probably not the best thing if you're somebody who doesn't have the ability to just do that. You should just be able to do a 30-year note.
Sure.
That's my opinion.
Yeah.
Now, maybe they could do it where you do a 50 and there's a lower interest rate. Maybe that might be, I mean, there's ways
Or you're
maybe they
able
can manipulate
to,
that, but if you're going to do that, just do that on a 30, like,
right.
so I don't think that's going to
But
happen.
houses are so much more expensive now than they have ever been. So that's why the first time home buyer is now in their 30s.
Yeah.
They're 30s
And
and
that's
up
what I
are the
think,
ones who can afford it.
and we're totally in agreement again. And we need to figure out how to get those young people or younger people into homes and to be a part of the American dream again.
Mhm.
It's an interesting thing. I think we're in a really interesting time because for more than not even actually less than half of the population right now, they're sitting pretty.
Mhm.
Whether they feel like it or not, they may feel trapped, but they're trapped in something good.
Right.
So for the other people, it's made it almost impossible for them to get into the game. And so we had to figure out how to put those two together, which gets us to the idea of the portable mortgage. Now, this I like.
Yes.
I do like this.
Let's break what that looks like down for people.
And
Let's break down what that looks like for
Let's start with what a
people.
traditional mortgage is. A traditional mortgage is against a specific property. So you go out and buy property A, and they look and they do an appraisal on property A, and they do all the things on property A, and then that mortgage is for property A. And when you sell property A, then they pay that off, and you start all over again when you go to the next property, let's say property B.
So if you bought in 2020 and you got a 3% mortgage on property A, now you're looking at a 6+ interest rate on property B,
And
which
so
can make a huge difference in your payments.
Yes, and so a lot of people may have a lower payment on property A than they would have. They might have a much lower on property A than they would have even downsizing to property B because of the interest rate, because it's so top heavy at the beginning. So the concept of a portable is to port it from A over to B. Now, I think you would still have to go through all of the same qualifications, appraisals, and all that in order to take that over. And then you would probably do a secondary loan for the amount in between. So it'd be like a first and a second kind of a situation. Or the other thing is if you have a lot of equity in the house, so you want to go ahead and cash out on that equity and then take this loan to kind of cover the new house. So you want to downsize, then you would have that money freed up. It just gives you a lot more options, but you keep that 3% on your, so you're not giving up the 3% on what you already have it on. You would have to go to a newer interest rate on the overage, or you would have to come up with the cash, or you would have to come up with, the equity over that. But for a lot of people, that's not a problem.
Right.
A lot of people have quite a bit of cash, but they don't have all the cash. And if they could take that mortgage and then go up another $100,000, they could do that. So that's pretty brilliant if we could make that work. I think it would be, you'd be stuck with, I think, the loan company that had the original loan, and that's fine. I mean,
but I wonder what the banking, now of course this is not our wheelhouse, but I wonder banking and loan companies, if they have that 3%, they're only making 3% interest. But so if the person takes
for them to
from A to B and it's still the 3% when they could be getting 6% on B,
so
I don't see them loving this.
Well, and that gets into, that's when the government, this is where it gets so interesting, because now you're getting into Republican, Democrat ideologies and all that. So now it's basically, the idea would be the government would be telling the lender, this is a government-backed loan, and so you must port this over for them at the same interest rate.
Which works with FHA, VA, and USDA because those are government-backed loans.
But I don't think
But
they could
what
do it
about
on
conventional?
I don't think they would be convincing the bank to do that on a conventional.
Which that means there's a lot of people that will be out of it.
Now, maybe the bank would be able to do a program somehow where they could, in order to keep and retain the client, could do something special in that blend of that, conventional moving over with a new loan.
Mm-hmm.
Like, you've been a good customer, so we can forego certain things. I mean, I think there's ways to incentivize that with the banks.
Mm-hmm.
But yeah, the banks don't want to, they're happy to pay out that and get a new mortgage on it. Yeah.
Buyers and sellers and real estate agents and investors will love that.
But I think you can start seeing also as a consumer, there's a lot of people with their hands in the pot, right?
Yeah.
And so, you come up with one solution, but then, well, what does that do to the banking industry, or what does it do to the, whatever industry? We always seem to get blamed.
It's always our fault and we're overpaid, right?
All we're trying to do is get the deal done and move it forward, right? But yeah, and then, but even like with that, with all the NAR stuff, everything is being evaluated and changed. And with AI, there's going to be a lot of different ways to, even the way credit will be scrubbed and things through AI.
Mm-hmm.
Like, they'll probably have a better vision of algorithm of whether you're good to pay the loan back or not now.
Very, very good point.
Because they can really do a lot more AI inquiries into things that we wouldn't see, and have them figure out what are the real signs of somebody who's not going to go through.
Right.
Now, it might, again, be bad because some people that are on that borderline might not be able to get a mortgage, but it's going to be interesting. We're in interesting times.
Very interesting times. One other topic I want to bring up, since we're kind of doing current event topics day, and this has even changed since I recently did a video on it. Now, out of 35 deals this year,
the roof
is
on fire. Yeah.
So literally, I'm on my 11th deal.
That's so crazy right now with the roofs.
We're in the 11th deal we're negotiating, but
and again, industries, insurance industry, roofing industry, mortgage industry, real estate industry. Yep.
Yeah. So, so if you didn't see the video, basically out of, I would say I haven't had 8 new roofs in the 7 previous years that the roof had to be changed in order for the deal to go through. Now I've got 11 in a year. This is in Oklahoma, if you're listening in another state. But basically, insurance companies here, many of them are saying if the roof is 10 years old, but definitely 15 years old, we're not going to insure it. So,
and now FHA, I've heard FHA and VA and all the government backers saying if it's an over 10-year roof, they want it replaced. So now
there's another wrinkle.
Not just the insurance, and that's the reason why, because they think that the insurance company is going to come back and say, no, we won't do replace. It'll be actual cost, not replacement.
Well, in Oklahoma, you may buy a 30-year roof, but we have brutal weather here. So it's not going to last 30 years.
And
it's not.
Here's
But
the dirty little secret. Even if you have replacement, they've upped the wind and hail damage deductible by so much that you still have to come up with 2, 3, or 4% of your home's value. Then you get paid.
Not the roof's value, but your
home's value. And people don't really know that. I mean, I think people think they're okay until they realize, like, I've got to pay $10,000, $15,000 before I get money from them. And that's with the best coverage.
And it's interesting with my sellers this year because, several of them said, but, I paid all this extra money for a 30 or 50-year roof. And I'm they don't care. The insurance companies are worried about their liability.
But that's a problem for the industry standards too.
I agree.
Think the roofing company should stop saying a 30-year roof.
Yes.
Because it doesn't make any sense for them to be able to say, oh, look, it's a 30-year roof, whenever they know that the insurance industry and the mortgage companies are really 10-year to 15-year window. So to me, it's a misnomer because people go, oh, yes, I want the 30-year roof, which you do want it because it's good quality, but they should stop saying it's going to
last 30 years. Because then your sellers are saying, I spent this extra money for a 30-year roof. Why am I going to replace it because it's 12 years old just because they said? And I'm like, well, it's not
my toothbrush could last 4 years, theoretically.
Do you want it to?
Yeah.
No.
But it could.
Yeah.
So I think that's I think it's a marketing issue too. Yeah.
So this year, when we're doing it, literally, I'm telling sellers, if your roof is this old, most likely you need to realize this is going to happen. Get your insurance company out here, see if there is a claim that you can make to get some help. But if not, you may be stuck with putting on a new roof, or
you may be stuck not moving, because if you can't afford to do that, but you can afford the insurance in the house, and a lot of people may choose, I'm just going to have to stay in my house then. I think we're getting to so many scenarios that are making people go, I may just be stuck. And we're trying to figure out how to, this is why we make the living that we make, because we're trying to constantly figure out how do we bridge the gaps and make it where everybody can,
it's a win-win.
A little bit of the skin in the game from everybody in this formula to get this to go, including ourselves. But so much of this is, it does fall on us because we do have to go, here's the whole picture. This is what your insurance company is saying. This is what your mortgage company is saying. This is what the appraiser is saying. This is what your buyer is saying. And this is what you are saying.
Right.
How do we put all that together? And right now there ain't no AI to do that. It's you and I doing it. Right.
And that's where you're exactly right. An experienced agent can start looking at these different things. And there are different, maybe the buyer and the seller.
Because God love him, an inexperienced agent doesn't even know these are issues. So they don't know what they don't know. And that's how you learn.
That's how you learn.
But
that's why you should have a mentor.
You need a good mentor, because right now there is so much that goes wrong. We just are living in a time when things are going wrong, and I shouldn't say wrong. They're going sideways.
Very differently.
They're going sideways because people are, the inspection companies are so afraid of being sued that they are very, very over the top on what they find. It's an older house sometimes. It just has some things, and nothing is perfect when it's like a house, but yet everybody wants that perfect. But then your insurance company, it's like, remember those things we were kids and say, this is your house, how the IRS sees it. And it was like a mansion. Yeah. And this is how the bank sees it. All those different. Yeah. I think that's right now is everybody's looking at your house so differently.
Yep.
You look at it as perfect. The buyer looks at it like it's diseased. It's just it. And we're in the middle going, okay, this is somewhere in between.
Right.
We're really somewhere in the middle here.
And if you find yourself in this situation, and it's not going to be just that buyer, chances are, if an insurance company says, if an insurance company says they're not going to insure it, unless you find an investor who's going to put a roof on, that then they're going to pay a whole lot less for your house. Pretty much you can.
But they're going to ding you for that convenience factor.
Exactly. So most likely, the majority of the buyers that come to buy your house, especially if the loans start requiring it, you're going to have to do a new roof. So that is a conversation I have now in every single, and if they don't know the age of the roof, we got to figure that out.
Yeah. I just kind of had an aha because I keep hearing, I'm really trying hard to understand where every generation in this formula is coming from. Because we all have very different views of the housing market right now.
Right.
And the younger generation has a real hard time with accepting, and I'm not saying that they're wrong. It's just they don't like the fact that so many houses are being bought by corporate investors, or even really mom and pop investors. They think all the houses should be bought by single family or whatever, which I understand that argument because it gives everybody the dream. But when you talk about all these things we're talking about and all the problems, there's actually probably a need for 20% of the houses to possibly be bought in this capacity for somebody who has the ability to go in and get them up to standard and maybe rent them for a while and then sell them out. I mean, I think we're in a very interesting time because whether you buy or you rent, you got to live somewhere.
Right.
And so
Well,
now,
not everybody, unfortunately. There is a homeless issue
but I
right
mean,
now, but yes.
in general, like everybody has to have a place to stay. I mean, that's really what we're working toward.
Right.
And so for some people, owning is just not viable. It's just not.
Absolutely.
And so you can demonize that, oh, they shouldn't be making them all corporate. And I understand that argument to a degree, but you want decent rentals. I mean, have you tried to find a decent housing? It's not easy to find a decent house to rent. And a lot of people don't want to live in an apartment.
And if investors come in and
they don't
buy
want to
a
commit
home,
to the area maybe they're here for 6 months to a year, so they want that rental. And they want to be their kids in school and they want them to play in the yard with other kids, but they don't want to buy that. So there needs to be some of that in the market.
Well, and if you have an investor coming in and they want to do a flip.
Yeah.
When they turn around and sell that house, it's going to be worth more. Guess what? That's going to affect the neighborhood comps.
And that's hurting our comps right now because there's been so much less of that when you go to comp things, it's hard to comp a lot of things right now because you haven't had that kind of lift in those flippers.
Yep.
So again, what we're demonizing and then what the reality is can be very different. And the idea of what you're demonizing may make sense and maybe something we need to work on. But the logistic of that is not just to say, you bad, me good. I mean, and that's the world we're living in.
Oh, yeah. Well, politics and social media and everything has
nothing
made
to do with
polarized
everything.
Everything.
America. Yeah. I mean, we are definitely a polarized America.
So let's go back to the roof. So if you find yourself as a seller, now you're going to have to put on a new roof that you weren't expecting. There are various scenarios. You know, your insurance pays for it, but insurance won't pay for it just because it's old. Sorry. You pay for it. Maybe you and the buyers figure out how you're going to split this.
You have to pay the deductible, which can be very high.
Yes, absolutely. You know, but I argue with this as a seller's representative that the buyers are now going to get a brand new roof that they're not going to have to replace for at least 10 years, and it's going to lower their insurance. You know, are they willing to invest in that? But
and for the seller, people expect to have a decent roof.
As the buyer, yes.
I mean, the buyer expects to have a decent roof. So you as a seller, you can't just say, what's fine, because you think it's fine. If it's leaking or a real problem, they expected to have a decent roof. And you can't just tell by looking at most roofs.
No, not at all.
Yeah. So it's, again, there's that balance, right?
And then one other option that is now available, at least here in Oklahoma, the Oklahoma Insurance Department has put together something called OK Ready. And it's where they offer up to $10,000 in grants and a grant means you're not paying it back, in a grant to help you put on an impact resistant roof or the highest impact resistant roof. So they're looking at it as a fortified roof. We're making our homes better and stronger and making sure you get the premium roof. So,
but I also looked into that. And have you looked into how you have to do the application?
Go ahead. Yes.
Because so you have to buy.
It's not as simple as it sounds.
You have to buy, first of all, you have to be in a zip code that they're covering it, which most of them seem to be right now. But then you have to get this higher impact, which is more expensive. But you have to be in a certain income level or capped level of income. And so for a lot of the people, it concerns me because a lot of people that would qualify on their income level, but then to have to buy the more, I'm not sure the 10,000, I think it would help, but I'm not sure it's going to be it's interesting. And
at least
you have to have one of their companies do it.
Yes, and
they have your roof,
and they are going to pay the contractor. They are not going to pay.
Which I get that because then you can't pocket it, but it's also like you're kind of then you get in the queue of their companies that they've approved. I don't know. It's an interesting because I actually looked into it because I'm having my roof replaced, and I looked into that, but it was like I didn't qualify because of the levels, and they're not terrible. I mean, they're, but it's, but I think it's a real consideration.
It's definitely something people are interested in.
I would look into it because you never know. You could fit perfectly into that.
Exactly.
$10,000 is a lot of money. Yeah.
I literally have gotten messages from people all over Oklahoma. Will you look up my zip code? Can you walk me through this? Because it is at least another option that a lot of people aren't talking about. They don't know about.
I mean, like if you're a teacher I think it's kind of for those, it's really for those kind of income level, like that kind of mid income level, like teacher, secretary, firefighter,
yeah.
policeman. I mean, it's a great program for those people.
Mm-hmm.
I just think people hear that and everyone goes, "Oh, I can get $10,000." There is sort of a limit how that works,
and it is up to $10,000, and it does not include mobile homes, condos. It doesn't.
And once the money is gone from that grant pool, then is it done, or does it?
That I don't know. That's a very good question. But usually that's how grants work.
Yeah.
The money's
so
there
much money until it's gone. Yeah.
Yeah. So
and I'm happy for Oklahoma to be doing that. It's good.
Yes. Yeah. And also your home has to be in decent shape. It can't be falling down and you just want a nice roof.
And I think what they're thinking is they're having a huge problem with the price of insurance in Oklahoma. It's doubled in the last, 3 or 4 years, doubled. And people are choosing to not insure.
Which is not an option.
But if you can't get your house insured because your roof needs to be replaced and you can't replace the roof, but yet you have a mortgage, you have to get insured. I mean,
that's when you may have to sell to an investor who then will come in and put on that roof.
Yeah. Or I mean, God forbid, get foreclosed on because you can't, but that's a reality here. Mm-hmm. So I think we have to we do need to fix all this. My gosh.
I'm exhausted.
And that's the thing too. Like we all have our politics and but it's like, can we just get some stuff fixed? Like we solve some of these issues. I don't know why this has to do with one side or the other. It's just semantics of houses and so hopefully we can get to that place. I feel like we're starting to get a little bit there.
I do too.
It just feels like there's a little bit of like people going, I'm exhausted. I just want to get solutions.
And just as we started out this podcast, what has always worked doesn't necessarily work now or work in the future. Mm-hmm. We need to be creative in a good and legal way, but be creative on how we can get more people to enjoy the American dream and be able to live that.
Absolutely.
And
that's what we believe in and why we do what we do.
Mm-hmm.
Yeah. And, I'm kind of at the place in my career where that's really more my mission than it is getting my numbers or doing, being whatever. I mean, that's all fine. But that was kind of more of a young person's game for me than where I am now. I mean, just being honest. But the idea of making sure that tent stays big and open and that people can buy in, because the other thing too, I just think we have to talk about, it is still the way to build wealth, generational wealth. And when we say generational wealth, what we really mean is your wealth for that you can actually pass on to generations, because you have lived in a house. I mean, think about how many of your grandmothers or grandparents lived in a little sweet house that they paid on every month for 30 years. And then whenever they got to a certain age, they didn't have to make that payment. And then your parents helped them take care of it maybe. But when they died, that little bit of money from that house went to their children and their grandchildren. And that's generational wealth. Wealth makes it sound like big bucks, right? Mm-hmm. And it can be, and you would like it to be. But really what it comes down to is just leaving with a little bit more than you came in with.
Yes.
And being able to hand that over to the kids and the people you love.
And not leaving,
the organization.
Or not leaving your family members in a lurch and debt because you didn't think about your entire lifespan and once you leave this earth.
Yeah. And, it's even like the reverse mortgage thing. I'm not saying it's a bad thing. I'm not saying it's a good thing. But, the thing is, like most of the time, those kind of allow someone to live in the house and they give them the cash, but then at the end there's not much for the heirs to take back. It still could be the right thing for that person. Could actually be the right thing for their children to not have, because it gives mom and dad a lump sum to live on.
Mm-hmm.
But at least you had that vehicle because
Mm-hmm.
you own that house.
Mm-hmm.
So I don't know.
But at least that's another option. You know what I mean?
Yeah.
When we're laying all the cards out on the table, somebody
It's an
who's
option.
straight out of high school wanting to buy a house, somebody who's in their 30s with kids, somebody who's retired, there are different needs and wants, income levels, and so many things to look at that. Yeah, I think we really do need to look at the individual and different programs that could work for different
I will
people.
say this, and this is going to probably turn a lot of people off, but I'm just going to say it. My first house, my parents helped me with. I mean, and God love them, and it was a great little house, but it was over off of the Broken Arrow Expressway. It had all kinds of structural issues. It was awful. I mean, but it was my house, and I mean, I lived in it. Was
I feel like you
literally
should beat
it
your
was like
chest on that one.
it was like
Nice.
living on the runway of an airport because it was so loud from the. But I mean, I got used to it. You know what I'm saying? And I loved it because it was my house, and I made it beautiful. But I think the other thing is younger people are going to have to realize you don't get your first house and it's going to be just like what you grew up in.
And it's not going
And
to
that's
be
a
your
problem.
forever home unless you do the 50-year mortgage. It might be your forever home.
And I think people our age with their children need to be better about letting their children know that, because I think sometimes, like when I take sometimes people to see houses with their children, they're giving their children unrealistic, like, well, you shouldn't do that because you need to this. Well, they can't afford that and that and that.
Right.
So then they go, I can't afford a house. Well, no, you can't afford a house in the neighborhood you want, that has all the amenities you want, that's the size but you could afford a house a little bit further over, a little smaller, with less amenities, and then you could move up. I mean, that's the one thing I will say that I think there's two sides of this issue, and one of them is there may be some expectations, and builders are going to have to build smaller houses.
Yes.
I mean, we're going to have to go back a little bit towards the 50s and 60s. And the other thing is, 1 in 4 people will never get married now. That's the statistic.
Because they can't afford to?
No, they don't want to. 1 in 4 people will stay single in their lifetime. They won't partner up.
Whatever works for them.
But think about that, because that's single people that may want to buy houses and have those houses. We're used to. So it's interesting.
You had
a
couple with 2.5
You're going to need more
kids.
houses than you did. Like when you have a divorce, you don't stay in the same house, hopefully. I mean, you go and you each do on your own household. So great divorces. I mean, that's a big thing right now. So there's a lot of things we're going to have to be prepared for.
Well, and I think, we brought this up before, but I think you really just made the point. 3 things sell a house: the house, the location, and the price. And at least in my previous years of selling real estate, it's always been, I want the house that checks all the boxes in this location. And now I'm having people saying, with houses being so expensive, price is the most important, and it needs to be priced appropriately, not so pie in the sky that I'm willing to give up my dream house and I'm willing to go to a different location just to get one that's priced properly that I can afford.
Yeah. And listen, situation drives the market, and that's not always the fun things, but it can't. It's death, it's divorce, it's marriage, it's children, it's all those things. People do have to move, people do have to sell. And I would say, 2008 was tough, but for real estate, but it was also, we had to work because people still had to exchange property. And we're in the same place now. It is happening, but it's happening for different reasons than it used to.
Yes.
And sometimes it's not as much fun. At least it's not as bad as it was, because we had so many people that were in foreclosure during that time period, and we're not seeing that. But I think the bigger
because of the equity, I think that people have built up.
I think the bigger issue is we're going to have more units. We're going to have more ways of paying for it. But we also don't want to create a 2008 where we make it such a great, that scares me, because we lived through 2008. And if you make it where it's just so easy to buy a house, because that's what we are supposed to do, that isn't really responsible.
Right.
People do need to be able to afford the house they buy.
Absolutely. And, we've been going through that with Peyton in Dallas. He makes an awesome salary as a director, but we started looking at houses.
They live in Dallas.
So expensive there.
Yeah.
So expensive.
But I just saw a thing today, their prices are coming down fast.
Well, they need to.
Yeah,
because
they are.
It's incredible. But, we really
Inventory's
thought
way up and prices are coming down there.
we were working on getting him set up to buy a house. He started looking. And then the more he thought, he said, no, I'm gonna rent another year and kind of get the landscape before, because he did start thinking about, how expensive the house was and the upkeep. And,
But see,
he doesn't have the apartment pool.
And see, this makes me proud of him
Mhm.
and of you, because he chose the right thing, because now the market is coming to meet him. The market wasn't where he needed it to be.
Right.
So sometimes waiting
Mm-hmm.
until the market meets you is the smart thing to do, instead of putting yourself in rack and ruin and then the market comes down and you're up here.
Mm-hmm.
Because then you've bought up here. And I think that's a little bit what's going on right now. I think people are nervous about buying here and then it going here.
Mm-hmm.
So we got to figure out how to get that averaged out. And we're figuring it out.
And the good thing about Tulsa, we stay pretty steady.
Yeah.
We
we've valued more than we have, but we still haven't valued to the level of most of the country in the last, they're
Agreed.
bubbling up. Yeah.
Yep. Absolutely. Well, we covered a lot of hot topics today. And if there is
Hot topics.
if there is, can you tell we're both Broadway? If there's a topic you want us to discuss, just message us and we're happy to talk about it, whether it's Tulsa related or real estate related.
Anything.
Yeah, pretty much.
Thank you so much for joining us. We'll see you next week.